This video will go over the accounting equation. It'll be a little longer than I would like, but this topic is foundational to accounting, so please bear with me. If you didn't watch my introductory video, I highly recommend doing so before proceeding with this one. I'll put a link below. If you have, let's get into it. Before we get to the meat of this video, let's review some basic definitions. First, we have our assets. Assets are company resources that we own and or control. They provide some sort of benefit, either right now, at some point in the future, or both. Common examples of assets include cash, equipment, land, and buildings. However, assets can include items owed to us like money. Money owed to us is essentially called a receivable because we have a right to receive it in the future. We can also have services owed to us. This is common when we pay in advance. For example, a company might pay 6 months to a year of rent in advance. This is known as prepaid rent. In this case, upon making that payment, our landlord owes us however many months of building occupancy. Next, we have liabilities. Liabilities are just what they sound like. They're obligations to third parties. Most commonly, they take the form of monies owed. For example, if we make a credit purchase and owe the vendor payment within a month, that's a liability. We're obligated to pay the invoice amount within the specified time period. Liabilities can also take the form of services or goods to be delivered at a future date. For example, imagine you purchase a gym membership. The gym will likely offer you a month-to-month plan, or you can opt to pay for a full year in advance to save some money in total. If you choose the latter option, your gym will have a liability to you, owing you 12 months of access to its facilities, which it would record as a liability. Next, we have equity. Equity is the remaining claim on the assets after liabilities are satisfied. Hypothetically, if the business were to stop operations and convert all of its assets into cash, however much the owner would receive after liabilities are paid off is the company's equity. Those three terms are the basis for our accounting equation. Assets equals liabilities plus equity. For example, imagine you purchase a building to use as an office space for $100,000. Also imagine that you provide a 25% down payment on your own and borrow the rest. You have a $100,000 asset, the asset being the building that you now own. Remember our cost principle. We record items at their cost because cost is objective. Your liabilities are $75,000, the amount you owe the bank or lending institution. Your equity is $25,000. Were you to immediately sell off the building and pay off the amount owed, $25,000 is likely how much you'd receive. Every time a transaction occurs, this equation is going to be adjusted. We'll either have an increase on each side of the equation, a decrease on each side of the equation, or perhaps an increase and a decrease on the same side of the equation. But no matter what, the equation must always balance. Before we proceed, I'd like to expound upon equity. Equity generally consists of the following four types of accounts: owner's capital, owner's drawings, revenues, and expenses. Owner's capital represents asset contributions made directly from the owner to the business. For example, if an owner contributes a certain sum of money, either to start a business or to fund a business expansion, the business is receiving that cash asset, and owner's equity goes up by the value of that contribution. Such contributions increase owner's equity. Owner's drawing is the polar opposite of owner's capital. Whereas owner's capital represents inflows of assets to a company from the owner, owner's drawings represents outflows of assets to the owner from the business. For example, If an owner decided to withdraw a certain amount of money from the business for personal use, owner's drawing would be impacted to reflect that distribution. Owner's drawing decreases owner's equity. Similar to owner's capital, revenues are another inflow of assets to the business. However, whereas owner's capital represents an inflow of assets contributed by the owner, revenues represent inflows of assets from the customers. More specifically, revenues are the assets we earn, namely cash, from providing goods or services to our customers. Whenever you earn money by providing a good or service to someone, you need to record a revenue. Revenues, of course, increase owner's equity. Opposite of revenues and similar to drawings, expenses are outflows of assets that occur as we try to serve our customers. Specifically, whenever we consume one of our own assets or utilize a service from an external party, we have an expense. Utilizing a service from someone else indicates that we're outsourcing the consumption of an asset. That is, we're paying that business to consume one of its assets so we don't have to consume one of ours. By paying that other business, we consume our cash asset. So that's from where that additional definition comes. Expenses naturally decrease owner's equity. Let's consider what I just said in relation to the accounting equation. On the left side, we have our assets, which consist of those aforementioned items. Remember that assets are company resources that provide an immediate and/or future benefit. Our equity will consist of revenues, owner's capital, expenses, and owner's drawings. Memorize that revenues and owner's capital represent inflows of assets that increase equity. In other words, anytime we record a revenue or owner contribution, we'll have an increase in equity as well as an increase in assets for whatever was contributed by the owner or earned from the customer. In contrast, expenses and owner's drawings represent decreases in equity through an outflow of assets. So these two will be accompanied by decreases in one or more of our asset accounts, usually cash. Let's apply what we just learned with a more comprehensive example. Thaddeus Hohosen Coates starts a business named Coates & Arms that rents out clothing, weaponry, tools, and machinery for movie and television production companies. Let's consider how the business's first set of transactions will impact the accounting equation. Number 1. Thaddeus invested $60,000 in cash and $25,000 of equipment to begin operations. C&A's cash asset increased by $60,000, and its equipment assets increased by $25,000, providing a total asset increase of $85,000. On the other side of the equation, owner's equity increased by $85,000, the total value of his contributions. Number 2. The company purchases land at $60,000 and a building at $160,000. C&A pays $30,000 in cash and signs a note payable for the rest. Land assets increase by $60,000, as do building assets by $160,000. The $30,000 cash disbursement is a decrease in assets. C&A owes $190,000 on the assets acquired, so that obligation is an increase in liabilities. At this point, total assets are $275,000, liabilities are $190,000, and equity is still $85,000. Number 3. Coates & Arms purchases $10,000 of supplies on credit. The supplies acquired are an asset, a resource that provides an immediate and/or future benefit, so they constitute an increase in assets. As a credit purchase, C&A hasn't paid cash just yet, but it has an obligation to pay cash in the future, so we have an increase in liabilities. The end result: assets total to $285,000, liabilities to $200,000, and equity is still $85,000. Number 4. Thaddeus contributes his personal automobile to the company in exchange for ownership interest. The vehicle is valued at $16,000. The car is an asset, so assets increase by $16,000. And since the car was contributed by the owner, we have an increase in equity for $16,000. Assets are now $301,000, liabilities are $200,000, and equity is $101,000. Number 5. CNA purchases $16,000 of additional equipment on credit. That additional equipment serves as a $16,000 increase in assets. Since the equipment was purchased on credit, we have a liability to pay that amount in the future. Assets total to $317,000, liabilities to $216,000, and equity still to $101,000. Number 6. CNA pays $1,800 cash to an employee. This cash disbursement is a decrease in assets. Every time we consume an asset or service from another party, we have an expense just as I described at the beginning of the video. A company does not own its employees. They are separate parties from the company and are employed at will. As an expense, we have a decrease in equity. The result of decreasing each side of the equation by $1,800, total assets still equals total liabilities plus equity. Number 7. CNA provides services to a client and collects $8,000 in cash. The cash received is an increase in assets. Whenever we've earned money, regardless of whether we received the cash, we have an increase in equity via revenue. Assets are now $323,200, liabilities are $216,000, and equity becomes $107,200. Number 8. CNA paid $700 for the month's utilities. Whenever you read the word paid, know that entails disbursing cash. So assets decrease by $700. Our utilities are a consumption of a service from the local power and or water company, so we have an expense which decreases equity. Assets are now $322,500, liabilities are $216,000, and equity is now $106,500. Number 9. CNA paid $2,000 to satisfy the obligation created in number 3. We have another payment, or cash disbursement, so assets decrease by $2,000. In transaction 3, we purchased supplies on credit, so we acquired an obligation. Here, we're satisfying part of that obligation, so liabilities decrease $2,000. Assets are now $320,500, liabilities drop to $214,000, and equity holds at $106,500. Number 10. CNA purchases $20,300 of new equipment for cash. Cash is being dispersed, so assets decrease. Equipment is increasing, so assets then increase as well. Total assets haven't changed, but the composition of assets has. $20,300 of assets are now in the form of equipment in the business as opposed to money in its bank account. Liabilities and equity will also remain unchanged. Number 11. CNA provides $6,500 of service to a client who will pay in 30 days. CNA has earned the money. Whenever that happens, we increase equity via a revenue. On the opposite side, we're not receiving cash just yet, but we have a right to receive cash in the future, or a receivable, which is an asset. Assets are $327,000, liabilities $214,000, and equity is $113,000. Number 12. CNA pays $2,400 to an insurance company for a 2-year insurance contract. The disbursement of cash is a decrease in assets. In exchange, we have an insurance contract. A lot of people think this constitutes an expense, but remember, upon making the payment, the insurance company owes us 2 years of insurance coverage. When another party owes us something, be it money like a receivable in the previous transaction or a service, whatever is owed to us is an asset. Also, like transaction 10, total assets remain unchanged. We've just changed their composition. Liabilities and equity also remain unchanged. Number 13. CNA pays $1,800 in cash salaries to its employee. This is a repeat of transaction 6. The payment of cash decreases assets, and the consumption of the service or labor from our employees is an expense that decreases equity. Total assets becomes $325,200, liabilities is $214,000, and equity is $111,200. Number 14. CNA receives $4,000 in cash owed by the customer in number 11. Our cash asset is increasing. We're also collecting that money owed to us, so our receivable, our right to receive money in the future, is decreasing. Just as in transactions 10 and 12, total assets, liabilities, and equity remain unchanged. Only the amounts within assets have changed. Thaddeus withdraws $2,000 from CNA for his personal use. Withdrawals are the exact opposite of a contribution. Cash is decreasing for the amount dispersed, and owner's equity is decreasing for the amount withdrawn by the owner. Total assets are $323,200, liabilities are $214,000, and equity is now $109,200. That concludes this overview of the accounting equation. We'll build on this information in the next video when we start recording our journal entries. If my videos are helping you and you want to return the favor, you can leave a thumbs up. If you have any questions or suggestions for how I can improve, leave them in the comments below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, share my videos with your fellow classmates and even your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.